When you think of the way wealthy people manage their money, you probably think of a scenario like this. Yes, Oliver, I'd like to move $739,000 to the trust fund. Hold on, I'm getting another call. But the truth is, most wealthy people tend to follow a relatively basic set of financial principles and practices that, with enough consistency over time, has allowed them to amass higher levels of wealth. In fact, most millionaires who have achieved longer-term financial success have applied a lifetime of millionaire mindset practices to capitalize on things such as strategic planning, the strategic use of debt, as well as investing and continuous self-education. And while the common idea of a millionaire is either some rich snob in the Hamptons or a genius blasting himself into orbit, the reality is that becoming a millionaire doesn't necessarily require an IQ that levels with brainiacs or top CEOs. Rather, most millionaires are just everyday people that are simply more committed to the idea of creating higher levels of wealth and who are looking to progressively increase the amount of income that they've amassed over their lifetime. But one thing that's certain is that wealthy people don't just wake up one morning to the sweet view of 7 figures in their bank account. That's probably just something that would happen while dreaming before actually waking up. Over the past couple of years though, in order to mimic the way wealthy people actually manage their money, I've sort of shifted the way I view and interact with my own income, along with the way that my money flows through my personal finances. Depending on how you earn and spend your money, you'll fall within one of these 3 financial categories. The first one being the financially unstable, the middle class, and then the wealthy, which of course is what we're trying to strive for. Starting with the financially unstable, these individuals spend money just as fast as it's earned, and they also flow all of their income through personal bank accounts in order to pay for their living expenses. Keep in mind, this is also more of a mindset, right? So any increase in income for the financially unstable pretty much just translates over into more drinks at the bar and or new clothing. So living this way makes it practically impossible to ever actually get ahead financially. There's very little self-development going on, investing is practically inexistent, and utilizing bad debt in order to finance this lifestyle is an option that might actually soon be on the horizon. The middle class, on the other hand, are usually in a state of financial comfort where they make enough income from either 1 or 2 income sources, usually employment income, and that is just pretty much spent on things such as expensive cars, purebred dogs, houses, and other items that appear to be assets. However, on paper, these are not actually assets that are creating more income for the middle class. And so this creates sort of a spiral of financial dependence. And then finally, we have the wealthy that utilize business systems as well as assets to create additional income sources and create higher cash flows that are going to flow not through necessarily personal accounts, but rather corporations and other vehicles to lessen the tax burden. If that sounded complicated, not to worry, we're about to break all of this down. So sit back, enjoy, and smash the like button. A fundamental concept about money that's extremely important to understand is the idea that money is nothing more than a tool used to further amplify your current values and way of thinking. So with this in mind, no matter which financial category you find yourself in, money will do nothing more than accentuate your current mindset around, well, money. If you currently have bad money practices, well, it's naive to think that further down the line, if you had more income just fall on your lap, this would change anything. Starting from within, learning more about proper money management and setting concrete financial goals is truly the only way to train your brain to start bringing personal finance and striving for abundance to the top of your mind, which will manifest itself through daily actions. The next strategy that I've used to mimic the way the wealthy manage their money is an alternative on budgeting, where I found it extremely difficult to keep track on a month-to-month basis of every single expense and transaction that flows out of your accounts. You start doing it, you're really motivated and pumped, and then after a couple of weeks, it just becomes sort of redundant and burdensome. So what I do instead is somewhat twofold. The first one being that I try to set actual targets for a percentage or allocation of my total monthly income towards certain categories of expenses or investments, where because every single month my income is variable through my different income sources, it's extremely difficult for me to say each month I want to put aside $5,000, let's say, to X investment. Instead, I just try to keep a certain allocation to each one of my targets. No matter what anyone else says, keeping your living expenses under 50% of your total monthly income should be your number one financial goal, other than paying off high levels of debt. That should should be your number one goal, because instantly, if you're able to reduce your living expenses, there's a lot more liquidity each month that gets unlocked that you can then utilize for investment purposes. Your living expenses include everything from your housing costs, insurance, utility bills, food, phone bill, and pretty much anything else that is a month-to-month expense. Now, if this strategy seems completely impossible or unfeasible for your current financial situation, well, lucky for you, it's not all too hard to find out where the main issue lies. It's either a question of increasing your income, reducing your expenses, or most commonly, a mix of both. And this all comes down to the single most important element needed to creating additional wealth over time, and that is increasing your monthly cash flows. Your cash flows are basically the difference left over between your income and your monthly expenses. Having positive cash flow is first of all important to keep you financially afloat each month, but then also to start investing into building up your asset column, which is the ultimate goal of the wealthy. The second thing that personally has helped quite a bit is that I keep track of my net worth on a month-to-month basis instead of keeping track of all my expenses and just being a penny pincher. This right here is something that I actually don't see many other financial YouTubers speak about, but is very important and has helped me tremendously, because this allows me every single month to take a look at where I stand financially. Have my assets gone up? Where are my liabilities sitting? And then also, how much equity do I have contributing to my net worth? Pretty much I know on a month-to-month basis whether or not I am spending more or less money than I should be, and how that's going to impact my net worth after doing this exercise for years now. You would never expect a company to disregard their current financial position as well as their shareholder equity. So why in the world would you disregard your own? Most importantly, start by tracking your income and your net worth every single month. Just do it. And if you're someone who does spend excessively, do start tracking your expenses and try to reduce them on a month-to-month basis. Wealthy people are also extremely cautious about carrying debt, the type of debt, and then also the interest rate associated to these debt vehicles. The difference between good and bad debt might not be anything new to you, but before taking on any debt whatsoever, take a look into the terms of the debt, and then also ask yourself whether or not you're going to be able to create a higher return on investment than the interest rate that you're incurring on this said debt. 90% of the time, utilizing debt that has an interest rate above 6% annually is something I try to avoid. Only on rare occasions where, say, I'm utilizing debt in a short-term time frame to upgrade a property and I know I'll be able to create a hefty return, will I use higher levels of debt, or interest rate I should say. But in any other instance where I'd be utilizing debt in order to finance lifestyle or even investments in, say, the stock market, is something I try to avoid at all costs, because consistently creating a higher return on investment is not something that I can guarantee. So while utilizing good debt in order to purchase cash producing assets is something that I've personally used to my advantage, and so do the wealthy, just make sure that you fully understand what you're getting yourself into and never spend any money that you cannot afford to pay back on any form of consumer goods utilizing a credit card. And if you're currently in a situation where you are carrying some debt, well, at least you can start paying it off as of right now if you're mindful of how this is impacting your finances. What I would usually recommend is to start tackling the debt that has the highest interest rate first, and then working your way down to the lowest interest rate. From a fiscal standpoint, this is typically what makes most sense, and you're lowering your relative interest burden each month. Speaking of financial burdens, what would this video be without briefly speaking about the idea of a proper tax strategy? As the wise pawnbroker Rick Harrison once said, there's only two things that are guaranteed in life, and that is death and taxes. For this reason though, the wealthy embrace this idea, and instead of just closing their eyes to it, they leverage tax professionals and deploy strategies in order to try and reduce their tax burden. And no, I'm not speaking about offshore accounts or anything of that matter. I'm just speaking about legal ways that everyone can start utilizing basic tax strategies. The proper utilization of registered investment accounts is pretty much the first place that everyone could start. In the United States, utilizing accounts such as the 401k, the IRA and Roth IRA, as well as down here in Canada, or up here in Canada, I should say, the RRSP as well as the TFSA. These are registered investment accounts that you can utilize starting today that will minimize your tax burden. For example, starting with the IRA and RRSP, while somewhat different, are quite similar in that you can make contributions towards your retirement, and those contributions are actually tax deductible from the year that you're actually making those contributions. And this is going to lower your taxable income in that year. For example, this right here is Wealthsimple's tax calculator. And let's say an Ontario resident were to make $50,000 in 1 year. Well, this is how much tax they would have to pay without any other deductions. And right off the bat, if someone uses their allocated RRSP contribution room, this would significantly reduce their taxes payable. On the flip side, alternative registered investment accounts such as the TFSA or the Roth IRA allow you to grow your contributions and dividend income in a tax-free manner. So later on down the line, when you're looking to withdraw some of these funds, you do not have to pay any taxes whatsoever on these withdrawals. And by the way, if you're newer to investing, one of the best financial vehicles that we have at our disposal in today's day and age is the exchange traded fund. This is something that I speak about quite a bit on the channel and highly recommend that most retail investors utilize to create a base to their portfolio, a foundation really. And so this is something that I would highly recommend you look into further. And in reality, passive market index funds or ETFs that track these passive index funds have a history of usually even beating fund managers that are paid to beat the market, and fees associated with these types of ETFs are rock bottom. And while we're on the topic of taxes, having recently just spoken about the idea of increasing your income for further wealth creation over time, well, I would encourage everyone watching to, at some point, if you're able to, try to start thinking about a business or side hustle that you can create that can also be incorporated. Corporations of all forms are hands down one of the most powerful tools used by the wealthy in order to flow their income through a corporation, which significantly reduces taxes payable. First and foremost, with business income, you can deduct all expenses that were associated with helping create that income in the first place. So right off the bat, this is going to reduce your taxable income. And then from there, business income is typically going to be taxed at a much lower relative bracket also. So it's really a win-win here. This means that if you do have a business as, say, your primary source of income, well, you could choose to pay yourself and live off of only $30,000 if that's something that would be possible for you. And then from there, leave all the rest of your business income in your corporate accounts and you will pay way less taxes. This is the basis of the concept though, and if you're at the stage where this is more of a reality, I would highly recommend that you consult with a CPA to learn other strategies that you can use with your corporation to reduce your taxes. And finally, there are 2 points I'd like to leave you with from this video, and these are both highly important in order to become more wealthy and properly manage your money. The first thing is that you need to learn to pay yourself first, both financially but then also mentally. The idea of paying yourself mentally and reinvesting back into your own self-education is hands down one of the most important things that you can do through your life to increase your knowledge and therefore apply that in your skills to the real world, which is going to help you increase your income. I really hope you enjoyed today's video. The main idea I wanted to get across is that on the internet, we often see different videos, titles, articles, whatever, about the secret way to get rich. And really, there is no secret whatsoever. It's consistently implementing over years and years, a set of financial principles and practices in your own life that are going to allow you to become wealthy. So yeah, I really hope you enjoyed today's video. If you did, please take a second, smash the like button. That's all I really ask in return. And if you want to learn more about stock market investing, personal finance, real estate, subscribe to the channel and hit the bell button for notifications on new content. If you want to learn more about stock market investing, I would recommend you start by checking out this video right here. But then also, if you want to take it one step further, you can check out my full stock market investing course down in the description, where you'll learn everything you need to know about stock market investing and crafting a portfolio suitable for your needs as an investor. Also, don't forget to check out all the links to resources I use and recommend down in the description. You can get free money for creating some accounts with Wealthsimple Trade as well as other platforms. So on that note, thanks a lot for watching today's video, and I will see you in the next one.